Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and quite a bit has changed over the past week or so in terms of how market sentiment has shifted a little. So let's talk a little bit about what we see and how we expect this to play out. Before we get started, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off by taking a look at the major equity indices and just what has changed here over the past week or so, before taking a look at the fixed income markets and understanding a little bit about the dynamics that have shifted there and the market reaction that has perhaps been a little surprising for some investors. Then we'll take a look at commodities, and some of the major commodities are at risk of some substantial downside. We'll take a look at which ones. Then we'll take a look at sector rotation model to take a look at the health of the market from a rotational perspective and which sectors are leading, which sectors are lagging. Taking a look at some of the economic indicators that we think are important to continue to further this debate as to whether inflation is transitory or permanent, before sharing with you some of our ideas here at the very end. But the primary question that we've been receiving from investors that I think is on most minds is really just, are the markets at risk of a larger pullback here, as we've seen a little bit more weakness here over the past couple of days. So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I want to share with you my technical research, the underlying data that we're currently looking at, and the economic research to help inform our decisions. So when we pull up the S&P 500, this is really where last week's fake breakout, if you will, above 422 or so, that failed and now broke back below that level, has really led us to believe that this is more has been and will be more of a range-bound market that we've seen here between about 404 here or so and about 422 or so to the upside. And the fact that we've tried to break out above that level, failed, and is now back below this level and is back to retest this 422 level, leads us to believe that this could be more of a range-bound market that we're going to likely see here on the S&P 500, with potential test all the way down to about 404 or so, which currently corresponds with the 200-day moving average. So when we look at this, also the other thing that we want to pay attention to here, as price made higher highs, we failed to make higher highs on momentum. This is concerning. So this means that we could still continue to see more higher highs, small higher highs. And if they continue to be formed with lower momentum, that leads us to even more negative divergence or more signs of exhaustion that could lead us to a bigger pullback. So we certainly are setting up where the risks of a larger pullback are starting to build here. And then when we look at the NASDAQ 100 index, the NASDAQ 100 is a little stronger than the S&P 500 because it has managed to hold these recent all-time highs around 342 or so. It is still trading above those levels, but we see the same signs of exhaustion: higher highs in price, lower highs in momentum. We see it both on the daily and weekly chart here, where we see higher highs, lower lows. And if you look at the weekly chart here, this is really some negative divergence that has been forming for a long time here. We continue to make higher highs in price on the weekly chart, but continue to see lower highs in momentum. This has been starting to form since the beginning of the pandemic on a weekly chart perspective. So this is, potentially a massive risk here to the downside with respect to the sizable moves we've seen here in the NASDAQ 100. Now, the thing about negative divergence is that it doesn't give you a sense for timing and doesn't give you any sense for magnitude. So be very careful. I don't want to scare anyone into thinking that you need to go out there and buy puts for your portfolio and hedge your portfolio. But these are some of the warning signals that we do need to pay attention to. And remember, this warning signal has been active for over a year. That doesn't necessarily mean that you need to go out there and panic. So be cognizant of that. When we look at the Russell 2000, the small cap index, we continue to see this wedge formation or triangle that we continue to form, which is really just a consolidation pattern after what has been a very strong move here to the upside. It remains in this consolidation pattern, and until it breaks out in one direction or another, that's going to be our base case here for the Russell 2000 or small caps. And then the one thing that concerns me here is really looking at the RSP, the equal weight S&P 500 index. So while the S&P 500 500 attempted to make a new all-time high, the RSP did not confirm that new high because it did not break out to new all-time highs. And since then, it is looking substantially weaker here. It's pulled all the way back here to this 146 level and has bounced off that level so far. So holding this range-bound motion. But if we see this start to break lower here, that again puts the S&P 500 at further risk of a pullback here towards the 200-day moving average and potentially lower if it breaks below the 200-day moving average. So this is starting to show that the market breadth on recent push higher is starting to weaken, right? So that's showing us that it's just a few stocks, perhaps mostly the mega cap stocks, that are trying to attempt to break out higher, while most of the stocks in the S&P 500 are just simply not following along. So market breadth is starting to narrow. That's not particularly strong if you want to see markets to continue to make new all-time highs. You want to see market breadth also expand and improve in that type of market condition. So things are not looking particularly strong here. The number of stocks trading above its 50-day moving average is currently sitting at just 51%. That's also not something you want to see as a market is about to break out to new all-time highs. You want to see that much closer to 70, 80%, or at least continuing to expand rather than contract that we have seen here over the past few weeks. This started to look a little stronger here in terms of market breadth. A couple of weeks ago, we talked about this, started to expand, started to look stronger here, but has really started to fail back below. So this is telling us that that breakout that we saw here a couple of weeks ago or last week was really more of that false breakout. It really was not, it did not have the market breadth behind it to continue as market breadth has continued to fall here. And then when we look at 10-year yields, this is really where, you know, we've seen the biggest shift, if you will, in terms of sentiment, right? Because over the past few months, quite a few investors believed that yields were going to continue to climb. And despite the fact that the Fed last week announced that they were likely going to raise rates a little sooner than expected and potentially started to talk about providing some insights into reducing tapering the bond purchases in September, despite that, we have seen yields fall here, which is kind of the inverse of what many market participants were expecting, which is an increase in yields. And initially, we got that increase in terms of yields, but that quickly faded very, very quickly, actually. So this, in my opinion, sets the markets up in perhaps even for a little bit more risk, right? Because we've seen a bit of a knee-jerk reaction in the opposite direction of what we're expecting. And yet, despite a decline in rates, equity markets failed to break to new all-time highs because we see this inverse correlation between rates and equities. As rates fall, equities climb, but we're not seeing that. We're not seeing equities continue to climb to new all-time highs. And I think we're at risk here where the market kind of gets this wrong a little, that as equity markets, as perhaps inflationary numbers come out a little bit more permanent than the market is currently expecting, the market is effectively pricing in that inflation is going to be very transitory. And that's part of this decline we've seen here in rates. But if, let's say, the numbers come out a little bit closer more towards permanent, we're not necessarily saying that it has to last as long as permanent inflation, but perhaps the inflation lasts a little longer than the market is expecting right now. That's going to cause a rise in yields. Now, a rise in yields, a quick rise in yields specifically, is likely going to be a net negative here for equities. So I do think that this knee-jerk reaction we've seen here in yields could lead to a potential knee-jerk reaction in the opposite direction if we see inflation is a little bit more permanent than the market is pricing in right now. And that could also drive equity markets a little bit lower here. So things are setting up for, in my opinion, more elevated risk of a pullback. That's not to say we're going to get a pullback, but the risks certainly are rising, in my opinion, for that pullback. And then when we start to take a look at some of the commodities, I do want to point out Bitcoin is at a very pivotal level here, 30,000. And just to draw a couple of lines here, 20,000, which was the major breakout here that we saw which goes back to the 2017 highs. 20,000 was the high. We finally broke out above that in December of last year, quickly rose from 20,000 to 30,000. And after that breakout here above 30,000, it made multiple attempts to hold 30,000, which held as new support. This kind of formed what I call a left shoulder here. And then you have this topping formation, let's call that the head, and then you have what's now formed, which is the right shoulder here. And this right shoulder has had multiple attempts between 40,000 and 30,000 as support or resistance. And this morning, just after I produced these charts, we have now seen Bitcoin break below 30,000. So this is a pretty substantial head and shoulders pattern. And one of the classic things about head and shoulders patterns is you see declining volume from left to right shoulder. And that's exactly what we're seeing here. So this really puts Bitcoin at risk of down to about $20,000 or so, because you have this large vacuum between 20,000 and 30,000 that really has had very little volume traded within this support level. So break below 30,000, which we just saw here this morning, in my opinion, brings 20,000 fairly quickly here to the downside. So that's a quick update on what we're seeing here in Bitcoin. We look at some other commodities like gold. Gold also had a very substantial move here to the downside last week on the FOMC meeting. And what we see here is a test of the 166 support level that held multiple times prior to this breakdown here. And the question is whether 166 holds or not. It is now below the 200-day moving average, which is likely going to provide a little bit of resistance here. A break below 166 does bring down to about 157 or so, which is the recent low here prior to this bottoming formation. So, if you look at gold on the long-term chart, it does still look like it's still within this downtrend here. Even though it attempted to break out higher here, it continues to see lower lows, lower highs, and is at risk of a potential pullback here or continuing on this downtrend that we have seen on the weekly chart. And then when we look at crude, this is really where crude, while has seen substantial gains here over the past few weeks, are starting to see signs of exhaustion here, both on the weekly and daily chart as we get higher highs in price, momentum no longer confirming those new higher highs. We're seeing this both on the daily and weekly chart, which increases the probability of a pullback here towards the $64, $66 region, which is the breakout level here before this recent rally. And then when we take a look at sector rotation, this is really where we started to talk about this about 3 weeks ago, where we said that the sectors are not rotating as they normally would. In a healthy market rally, as equity markets are pushing towards new all-time highs or continuing to rally, we want to see a fair amount of sectors moving in one direction, while a fair amount of sectors moving in the opposite direction, kind of this rotation model that we're used to seeing. However, we're not quite seeing that. We're seeing a little bit of rotation here. We're seeing energy and real estate come down towards the weakening and starting to move towards the lagging category. We do see discretionary and healthcare moving towards the leading category, but largely things have pretty much have been the same. You have technology continuing to move and is the only leading sector here at the moment. And then you have multiple sectors, staples, industrials, materials, and financials continuing to move towards the lagging category here. And communications moving into the weakening category here, and utilities moving back towards the lagging category. So you really see this lack of rotation here. And if this continues going on for quite some time, which, right now, this is about almost 3 weeks already, that's not particularly strong because, again, a healthy market rally needs to see more rotation. We're just not quite seeing it there. So let's take a look at some individual sectors that I do think are worth paying attention to. So like I said, consumer discretionary is one of the sectors moving towards that leading category here. And what you have is what looks like a bit of a head and shoulders pattern that's starting to form here in consumer discretionary. Normally, you would think this as a bearish pattern, but if it does break this right shoulder to the upside, that's what we consider a failed head and shoulders pattern. And a failed head and shoulders pattern is actually a bullish pattern. So this is one that's worth paying attention to, because if you see a breakout above 174, that certainly would target 180 here to the upside for consumer discretionary. If this continues to break down here, that will complete the right shoulder here. And especially if it breaks below 166, that certainly starts to put consumer discretionary into far more trouble here to the downside. But we're on the verge of a potential breakout here. And if we do break out higher, that certainly would be a positive for consumer discretionary. You have a somewhat similar pattern here in technology. You have a double top, or this could even be a triple top, but regardless, a double or triple top breakout here is a bullish pattern here. If we break out above this 144 level, that certainly puts technology into a leading, continues technology as a leading category here in the markets. And if technology continues to lead higher here, that would further provide evidence that, market breadth is starting to weaken here, because you're just really seeing one or two sectors continuing to dominate the markets higher. Those are some of the things that we saw in January and February of 2020 prior to the pandemic sell-off, where it was just technology and discretionary dragging the markets higher, while the other 9 sectors were really just barely keeping up with the broader markets. So we're starting to see the early innings of that. Now, the question is whether this continues or we start to see technology come off, we start to see discretionary come off, and we start to see other sectors start to improve. Then we have the makings of what could be a healthier market rally. But we're in the early innings of what we saw back in January and February of 2020. And the question is how long this goes on for. The longer it goes on for, the more we are at risk of a broader, larger structural pullback here in equities. And then when we look at when we look at healthcare continues to remain strong here. Healthcare is in what would be similar of a consolidation pattern after has been a strong move here to the upside from about 110 to 122. It's been sideways here, and it is potentially on the verge of a breakout here as well, looking stronger than most of the other sectors from a relative strength perspective. So healthcare, discretionary, both at potential breakout levels here, worth paying attention to as you're looking for markets in a range-bound market. You want to make sure you understand where are the stronger markets, where are the weaker sectors here. So shifting directions here a little bit to the economic picture and some of the continuation of the discussion we've had over the past few weeks with respect to inflation, transitory or permanent. One of the two things that the Fed have mentioned in terms of their argument that inflation is more transitory. Wage growth, they made certain claims that they believe that most of the labor shortages that we have are going to resolve themselves, at least by around September, when some of the unemployment starts to taper off here. And they also talk about supply shocks, the supply strains that we're seeing that are likely going to ease on their own and kind of bring down consumer pricing inflation as well. So I want to take a look at some of that underlying data and take a look at what's driven the labor shortages. Is it simply just the fact that unemployment is high and people are just not motivated to go back to work until those unemployment numbers come down, or are there other more permanent factors here at play here, and also tracking those supply constraints? What increase we've seen in terms of consumer good pricing, because if we start to see that decelerate, then those are some of the signs that those things are starting to come off here. So those are some of the things that we're going to continue to track here over the next few weeks here. But when we look at wage growth, right, we're seeing wage growth pretty much across all sectors at the moment. It's not just in the sectors that are high in terms of leisure and hospitality, but we're seeing it across the board. But one of the drivers of this labor shortage is really due to the forced early retirement that we saw of many workers in the early days of the pandemic. We're seeing this issue play out here in the airlines. We've seen American Airlines, early retired a lot of pilots in the beginning of last year, and now they're having issues with bringing pilots back on. They've canceled a bunch of flights this week. They expect to cancel a bunch of flights in July simply because they don't have enough pilots or staff to fly these planes. And this is not just an airlines problem. This is a problem across the board. 1.2 million people have early retired, so well above the normal pace that we would expect. So this is causing some of that labor shortage of people who effectively went into retirement early. And then you combine that with the fact that typically when you have labor shortages, you can artificially inflate it, if you will, with immigration. Yet immigration is still also at all-time lows, 20% of what we had prior to the pandemic. So when you have labor shortages and you don't have immigration to replace some of that, and the question is really how fast can immigration come back online? And right now we're still at 20% below pre-pandemic levels. So immigration unlikely in the short run to replace and provide some temporary relief to these labor shortages. So, from my perspective, I don't necessarily think that by September things are just going to alleviate themselves magically. So I think that we're closer to, in the middle. You have transitory on one side, you have permanent on the other side. I think we're much closer to the middle than the market is currently pricing in right now. And the other half of this equation is really consumer goods, right? Supply chain constraints have severely impacted manufacturers' ability to produce consumer goods. That's caused a increase in terms of price of consumer goods. So those are some of the things that we continue to see in ISM, in inventory levels, in pricing power. So this is another one. So continue to see a rise in pricing power here. 42.9 versus 38.8 was the last reading here for ISI retailers. This is telling us that we continue to see strong pricing power from retailers. That's just further of this supply constraint. Until we start to see this level decelerate and start to perhaps come down, that's when we know that this supply constraint is still going to drive inflation for consumer goods. So these are some of the things we're continuing to track. Like I said, from my perspective, I don't see a slowdown here in terms of the supply constraints just yet, and we certainly don't see a resolution to the wage issue that we see right now. But we'll continue to track this and update you here as we see more information. So as we look for opportunities here in this market, this is really where I think you have to be very selective in terms of sectors that you choose and specific stocks that you choose. I think looking for quality names within sectors that are relatively strong are really the only ways to go here at the moment. I think there's a lot of risks here to the downside if you choose the wrong stocks. So one of the stocks that was of interest to me was Home Depot. We've seen a substantial decline here in housing stocks over the past month or so as mortgage applications started to slow down, as housing starts started to slow down. But that was, some external factors due to things like lumber and raw material pricing that has come down a little bit here over the past month or so. Lumber is down about 40%. That's eased a lot of the concerns that housing stocks have started to perhaps reverse their reluctance to continue to start building new houses or sign new houses. So as we start to see things normalize a little bit, the fact that Home Depot pulled all the way back from about 350 back to the $300 level, which is the 200-day moving average, and yesterday bounced off of that 200-day moving average, I think it's constructive for Home Depot to continue on that upward trajectory. Now, perhaps I don't necessarily believe that will continue at this steep of a rate, but continue its upward trajectory here on the long-term chart, as you can see, and maybe move in a more slower but continuation higher here for a name like Home Depot that continues to be the dominant player in this particular space. Second one I want to take a look at here is real estate, and specifically some of the subsectors within real estate that are more exposed to technology, specifically Crown Castle. They lease cell phone towers here, and we talk about 5G as an opportunity here over the next few years. We're really talking about a huge expansion in the number of cell phone towers that are required to utilize 5G. 5G requires millions of cell phone towers, much smaller towers versus the current infrastructure, which are much larger towers. You don't need as many of them, but 5G requires far more smaller cell phone towers. So Crown Castle, a leader in this particular space here as well. As you can see from the stock, very strong stock here over the past few months, despite the weakness we've seen here from technology and the S&P 500 continues to climb to new all-time highs, does not see the same type of exhaustion we're starting to see in some of these names making new all-time highs, and has the opportunity, in my opinion, of continuing higher here. And lastly, United Health. United Health remains one of our strongest names in the healthcare space that we like, and the fact that it's pulled all the way back towards its breakout level here, just around the 380 level here or so, and has bounced, is constructive here for a continuation higher here. But I will say here for United Health, I'd like to see the breakout above the 21-day moving average before looking for opportunities here in this particular stock. And we're just there at this level here. So pay attention to United Healthcare. If it bounces lower here, I would wait for a pullback towards the 200-day moving average for that next leg higher here. But if we do start to see a breakout here above the 21-day here, that could be an opportunity, in my opinion, back towards 420, 425, and potentially higher for one of the strongest healthcare names in the markets here right now. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding as to the broader markets, how we're currently viewing the equity markets with respect to some of the underlying indicators that has some, in my opinion, some risks that are bubbling up here at the moment in terms of the equity rally that we're seeing. Not enough to go out there shorting the markets, but enough to be a little bit more concerned and aware of what things are starting to play out here. With that, thank you so much. And one piece of housekeeping items before we run off here for today. The Thursday educational webinar that we normally do at 4:15 every single Thursday, we're moving that to 3 p.m. this particular Thursday. So this week, for this just week only, we're moving the Thursday 4:15 p.m. Options education webinar to 3 p.m. Eastern time just for this week. So with that, thank you so much. Have a great trading day, and I'll see you guys here on Thursday at 3 p.m.